This is Greg Rand, otherwise known as the Chief Strategy Officer for Renters Warehouse USA.
Hi, everybody. Nice to see you. Thank you very much for having me, everybody. I'm excited about this. As Rich just said, my company was recently bought, so I've got a lot of changes happening in my life. My wife, gotta love her, she said, so you've been CEO of something for 20 years. What are you going to do when somebody tells you no? Because I've got a new 35-year-old boss. I'm a 50-year-old guy. She says, what are you going to do when somebody tells you no? And I said, well, thanks to you, dear. I've been hearing that for a really long time, and I'm quite accustomed to it by now. Thank you. All right, good. All right.
True story.
All right, good. True story. So I spent the last 10 years dealing with large Wall Street firms that got into the housing market for the first time. You might have heard about them. You might have competed with them when you were buying property. Those are my clients, and we learned a lot about how to analyze real estate markets locally, regionally, nationally, how to figure out the market cycle. And when I thought about what value I could provide to you folks tonight, it kind of centered around this idea that there's a lot of really bad analysis out there, and I wanted to share with you some of my favorite hits about stories that have been coming out in the last 12 months about the housing market, how wrong they are, why they're wrong, and then show you why all those Wall Street clients that I've worked with the last 10 years are all coming back to the table with hundreds of millions and billions of dollars more to buy more, despite the fact that they're reading the same stories you are about how the housing market is plummeting, plunging, failing, et cetera, et cetera. All right, so hopefully that'll be valuable. I'll kind of go through this relatively quickly. Then I'm going to show you a quick analysis of the Houston market that I was recently sharing with some of our clients who are very intrigued by it and who, well, they were persuaded that it's got a lot of running room still left in it, despite the fact that it's gone so well for so long. So this article I really enjoyed because that was the headline, our friends at Zillow, experts predict recession in 2020. And this was the graphic that the news service chose to put on top of the story. So, economic crisis, this is last year, experts predict. You know what it says in the subhead? Nearly half of the experts predict a crisis in 2020. So what does that mean? That means that more than half of them thought it wasn't going to happen. Right, so that kind of ticked me off because I'm thinking, you put 100 economists in the room when most of them agree that it looks good through 2020, you would think that would be the headline, but it wasn't. So it makes you wonder what Zillow is thinking, makes you wonder what this news service, it's known as Inman News. It's a real estate news service that is almost kind of rooting for a recession in 2020. I can't figure out what's going on in 2020 that would make anybody want to root for a recession, but maybe I'll come up with that answer someday. Here's another one that I loved. This is like 3 weeks ago. Business Insider. Americans stopped buying homes in 2018. No, they didn't. They bought a few less homes. But I really enjoyed the image. Isn't that nice? You go through these bullet points, and it's all about how the housing market's not collapsing, but, all right, but they chose that image of the building crashing to the grounds. There's a lot of people that see something like that and think, well, maybe I shouldn't buy real estate right now because all the geniuses that Zillow interviewed and all the smart people about global finance over at Business Insider think that, well, whatever all this says, that's the thing that catches my eye, right? So it's my intent for anybody who's interested in knowing what's really going on to look at those things and come away with one conclusion. You cannot believe what the people who write for these news services say. I don't know what their problem is, but that's not right. That image is just wrong, and there's a lot of people that you might compete with in the investment space that are going to buy into that, and that's going to be an opportunity for you. When it's the right thing to be optimistic, being pessimistic is not practical. All right? When the market is actually healthy, being pessimistic is not practical. Believing that story is a mistake. Here's another one that I loved, okay? And I'm going to back up, instead of just kind of trashing them, I'm going to back up some of this a little bit with some data. Home values see largest single month decline since 2012. Another real estate news service wrote this, all right? And this was because in November and December, home prices went down. But here's the problem. This is a chart that shows what home prices do every year. November, 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 November. So what they don't know is that all you measure is how it was compared to last November. You don't measure it compared to August because it goes down every year in November, December. It's a little thing called the holidays, right? Seasonality matters in the real estate market. People are very busy in the spring. Why? The weather's nice. They're getting ready to make a move. They want to time their move for the school year. So things slow down after the school year and things freeze up in the fourth quarter because, you know, Christmas and all that. So this was a news service that supposedly knows all about the housing market, and that was their headline, and that's the reality of it. So they either don't know that home prices are down every December and November, or they do know and they have some other reason to be lying to all of us. I don't care which it is. All I know is that you shouldn't believe them. When you see a headline that says it's bad news about housing, understand they wrote the headline before they looked at the data, then they try to find something in the data to support the headline. Right? This was my all-time favorite, then I'll move on. This came into my email from something known as the Street Report. I don't know what it is. I don't know how they got my email, but I got the Street Report, and it said in their headline, Fed could double rates in 2019. Fed could double rates. I clicked through because I'm like, that wouldn't be good. You know what the story actually said? The Fed said they might raise rates 2 times in 2019. So they conflated 2 times with doubling. So I couldn't find it. They changed it. Somebody called them and said 2 times means 2 times, not 2 times. So anyway, don't believe them. They're wrong. They lie. They're stupid. I don't know what it is, but it's maybe a little bit of all the above. And my clicker is not clicking. Yeah, let's try that, and I'll tell another joke about my wife insulting me if you want. I've got a lot of those. I actually don't. Did it go dead on me? It's working now? Awesome. Okay, so Houston is an interesting city when it comes to media because I first took notice of Houston back in 2000. I mean, I knew it existed, but from a real estate analysis standpoint, back when oil prices went down back in, was it 2012, 13, something like that, 11, whatever it was, and the stories back then were Houston's over. Houston is only the energy industry, and so it's over, right? And they actually had a picture of people hanging out in a restaurant, in a diner in Houston, lamenting how the housing market was over, the economy was over, Houston is finished. And I saw that, and I'm thinking to myself, is the energy industry the only industry in Houston? So I looked it up, and it's not. It's an important one. It's not the only one. It's still here. It's always going to be here. And then we've got 2014. Soaring home prices. That's good news, right? After the economy is supposed to tank in Houston, then a year or two later, the home prices are soaring. What could be bad about that? Well, in this case, it's going to hurt its reputation for an affordable city. You ever heard a story about Apple stock way up? That's bad for affordability of Apple stock. You never heard that. That would be absurd. But that was this story. That's 2014. Here's 2014, end of the year. Housing market expected to slow down. Oh, we hope so, right? We hope so for some reason. And then here's the next year. Houston housing market takes summertime hit. So it didn't slow down. It kept rocking on. It kept going well. And now it's expected to take a summertime hit. But unfortunately for them, it didn't take a summertime hit. Then we had a terrible hurricane. Houston was over because of the hurricane. That's what the national media said about the housing market. All these houses flooded, terrible situation. And for anybody in Houston who's worried about the local economy, anybody who's been flooded, anybody who's got friends and family who are flooded, now you have something else to worry about because we think there's going to be a giant problem. This headline says the housing market, this is a year later, housing market shows huge distortion. You know what the distortion was? The distortion was it kept going up anyway. So the headline talks about something bad happened. Something bad happened is Harvey didn't crush the housing market. Okay? And so now we have a distortion. That was like in paragraph 3 what they meant by that. I could go on all night with this. I cut myself off into this one. Home appreciation rates could nearly half by 2020. Now, how many people who read that think they mean home prices could get cut in half? Some people do, all right? Home appreciation rates that have been 6% per year, every year for the last 20 years could half. That means they could go to 3%, which means the houses got more valuable, just not as much more valuable as maybe they had in the last couple of years. So you get my point. Let me tell you what actually has been happening in the housing market nationally and then in Houston for the last several years. This is a lot of years. This is Great Depression through Great Recession. And when you hear people say the housing market goes up and down, you've heard it's cyclical, right? Housing market is cyclical. But people translate that all the time to what goes up must come down. No, that's the stock market. The housing market did this. And the interesting thing is, what about the 2010 decade jumps out at you? Anybody? It's above the trend line, right? It's too high. So what happened? The market fought its way back to where it wanted to be. It gave back some of the appreciation. So this thing was happening because people were being born, people were moving here. They tend to like living indoors. They oftentimes have kids who want dogs. They want to live in houses. That's it. That's the housing market in a nutshell. And so during all this period of time, it went up. When it went up too high, it corrected. So here's the same data from a different source that shows you how that looked over the last 50 years. And so you see Democrats, Republicans, wartime, peacetime, high rates, low rates, cats and dogs, and you see this steady curve, and then you see this thing. This was the housing boom. We all know about that. Most people, I think, by now know that what caused that was very, very relaxed lending standards. The way it looked in the field was people who wanted to buy a $200,000 house got a blank check from the bank for $300,000, and then just got into bidding wars and drove prices up too high. It was funny money. It's like college tuition is too high because there's a lot of student debt that's kind of funny money, same problem repeating itself. But you look at this chart, and what you see, oops, go back there. What you see is a trend line that the market went too high, it corrected itself. I mean, it mauled everybody is what it did. Anybody see the movie The Revenant? Right? Leo DiCaprio versus a grizzly bear? Right? There's a great scene where a grizzly bear beats Leo DiCaprio up for like 15 minutes. And he bites him and claws him and steps on him, takes a break, he's sitting on his back, and then beats on him so much. So that's what the housing market did to us because we jabbed at it with a sharp stick. It didn't like it, it corrected, but then it fought its way back. It might be a little bit high right now. But look at this, 1980. There was a housing crisis in the early 1980s, according to a lot of people in the real estate business. The crisis was in their business. If you sold homes for a living in 1981, you had a big problem because interest rates were at 19%. But look what happened to home values. They leveled off. It wasn't this. It was just, okay, nobody's buying houses, but because demand was essentially still there, home prices leveled off. Real estate crisis of the early 90s leveled off. What we think is happening here is that we've had a really, really strong recovery, and what we're going to see now is what you see beginning to happen right here, right? This is a little bit too steep for I think it should be right about here, on that 50-year line. It's above it, so it's cresting now. It's going to level off, and so the question is it going to plummet, as people in the media are going to want to tell you is probably, maybe, hopefully happening from their perspective. So let me share a little bit about what goes into this. Okay, the cycle. You've heard of the pendulum, right? The market pendulum. It goes back from buyer to seller. Over here, we've got, this actually got messed up when I transferred my slide over to this laptop. So this S is supposed to be huge, and this B is supposed to be tiny, because that's a seller's market. So forget about the size of the letters here. This is a seller's market. Seller's in control. The seller is the one that has all the power in the negotiation. Over there, the buyer is supposed to be huge. And along the way, you see the seller shrinking, the buyers growing. Here's a nice, even, balanced market. Then it goes up that way. So what's interesting about this, I've been teaching this for 10 years, but what's really interesting is this last 12 months, this whole conversation has been all over the place. What's happening in the housing market? 12 months ago, they were talking about affordability is low. What does that mean? House prices are too high. People can't afford it. What's supposed to happen when that happens? Let's just go to the chart here. All right, so in a seller's market, Seller's market are where the seller is in the pole position, okay? He or she is the king on the throne and queen on the throne, and the buyer is bowing and scraping and trying to buy the house. There's too many buyers, not enough properties. And what you got is high demand, low inventory, bidding wars, a lot of transactions. Realtors are really happy. A lot of sales are happening. I love realtors, by the way. I make fun of them because I'm kind of from that world, so it's okay. Sales prices are rising because all these bidding wars are driving prices up. The question is, when is it going to shift back? When is this pendulum that is stuck up in this corner likely to break loose? And the answer is when prices go up too high that buyers can't afford. That's called affordability being too low, which we had a year ago. It was all over the headlines, appropriately, except that they were saying affordability is too low. What are we going to do? And the answer is don't do anything, because when they can't afford it, they're not going to buy it. Okay? And so what happens next is the market breaks loose, starts making its way back down the pendulum, and at some point, you have a nice, balanced market in the middle. So the question is that where we are now? What that looks like is demand begins to decline, right? The buyers can't afford, so they don't buy. Maybe they buy something cheaper. Maybe they just get sort of stubborn, right? I'm not paying that price. I'm sorry, seller. I'm putting my foot down. I'm not going to pay that price. Demand declines. The number of transactions declines. That's supposed to happen, right? Just picture a supermarket shelf during a blizzard. All the milk and bread is gone. Then the storm passes, and then all of a sudden the inventory begins to accumulate again because the hyper demand goes away. And when the inventory increases, what is supposed to happen is the sellers finally blink, right? The sellers finally say, okay, I want to sell the house. I've been having a great run. I priced this is like an individual seller-buyer story happening 5 million times across the country in the same year, all right? Sellers got a little bit crazy. Buyers said, enough. That's a New York thing. Enough. And then eventually they capitulate and they get more reasonable, and then sales prices flatten out for a period. That's a balanced market. That's where I think we are right now. All right, so let's go back to 10 years ago. We had a crazy seller's market because buyers were frothing, the economy was crazy, and they had all that funny money. Then we had a balanced market for like a day. For like 15 minutes, we had a balanced market because the buyers said, not only am I done with you, but now I think there's a housing collapse going on, and then all of a sudden 2008 and everything else. So then we had a buyer's market for like 5 years. Sellers couldn't sell their houses, and then what that looks like is instead of a bidding war where buyers are outbidding each other and driving prices up, we had a reverse bidding war where sellers were undercutting each other to try to sell their houses because the buyers were being super stubborn. The demand wasn't there, all right? The economy was falling off a cliff. That was the talk back then, right? So we had a buyer's market for a period. Then we had a balanced market again. The prices came down to a point where investors and home buyers finally figured out that now it's actually good, all right? They didn't know this chart was here, but they knew that it was good. The economy was starting to improve. 2008 was in the distance now, and they started getting confident again. And then we began into a seller's market again, all right, for most of a decade, and then we're back at a balanced market. So the only real question right now, and the one that I want you to ask yourself when you look at a year's worth of headlines that say affordability is low, that's bad, and then home sales slow down, that's bad. That's not bad. That's what's supposed to happen. Now, home prices are starting to go up at a lower rate than they used to. Well, that's good. That means home prices are flattening out. The market is behaving in a healthy fashion, right? The market's behaving in a healthy fashion because the buyers have free will, all right? And they're not buying things that they know to be too expensive. There's transparency in this market. Everybody knows what houses are worth if they want to look it up. And in the end, the big question becomes, are we here and are we heading there? Okay? That's what people are starting to talk about. What I want you to know is not what I think. I want you to look at what that looks like. And if you start seeing real, genuine signs that these behavioral patterns are happening, then we're going into a buyer's market, and that could be bad for home values. And here's what a buyer market looks like. Demand is low. People don't want to buy houses. It's not about being stubborn on price. It's about they don't want to buy, okay? Number two, inventory is high. Right now, inventory is beginning to accumulate, but is inventory high? It's only getting to a normal level. If it got too high, that could be a problem. The transactions aren't happening, so the realtors are having a bad day. The sales prices begin to drop. So leveling off is not good enough anymore. Now people are stubborn. The economy stinks. This is what has to happen. The economy has to stink. Unemployment has to go up. Consumer confidence has to go down, right? The overall economic circumstances have to be lousy for this to be the situation we're headed into, okay? And the shift would eventually happen when the prices came down far enough and buyers finally said, okay, now I'm interested and the economy is good again. All right, so I want you to look at, if you know this pendulum, okay, what I'll do is I'll make this available, so if you guys want to email this presentation out to anybody who cares, would you guys like to have this in your inbox? Okay, good. Because I've been right so many times over the last 10, 15 years because I understood this, and I built a reputation on Wall Street with these big clients that I love those guys, but I love you guys a lot more. Like, my passion really has always been the every person investor. I want everybody here, I want everybody out there to, you know, retire with 25 houses paid off, if that's the right number, right? I feel like we're in a role at Renters Warehouse because we're building a real estate company on top of the property management company. I didn't mention that before. So we're a national property management company, and we're building a real estate company and a Zillow-like real estate website on top of the property management company, so we can say, you want to buy properties? Let's help you understand where the market is. Let's help you research markets. Let's help you meet with somebody in the conference room, make a plan for your long-term investment strategy. Let's help you execute on buying the houses that you want to buy, and then we'll manage them for you too. And then you'll blink, and 20 years will go by, 25 years will go by, and your life will have changed because of what we did with you. That's our mission in life, okay? And so I want everybody to understand, like, the minute that I think it's a bad time to buy, I'm going to be standing here saying, don't buy. Wait 48 months, 36 months, whatever, because it's going to get cheaper. That's not what's happening right now. Like, I'll bet my right leg that houses in Houston and every place else in America, with very few exceptions, are more expensive 1 year from today. In fact, I had somebody mouthing off on LinkedIn about this, and I said, okay, fine, professor, because he was, $10,000 bet that home prices are going to be higher in a year, $10,000 bet that they'll be higher a year later, $10,000 bet they'll be higher a year later, and I bet him $100,000 that every year over the next 10 years. I knew he wouldn't take it. He didn't. That was a little risky. My wife saw it. I said, honey, I just used the college fund. It's no big deal. But the point is, when the economy is good, housing demand is strong, and little blips on the chart that happen, like, you know, like 4 weeks ago, the stock market went down like 800 points in a day. Remember that? And then it went up 300 and then down 400 and up 400 and down 600 and went crazy, right? The reason why that started, it turned out, was that two of the administration officials who talk about economics went on two different news channels and contradicted each other. So the stock market went down 800 points in a day. You know what the housing market did? Nothing. It did, yeah, it went up a tiny little bit. That's all it did. It doesn't, it's like the stock market is like a boat on the surface of the ocean that when there's a hurricane blowing, it's getting flipped back and forth, turned upside down. The housing market is 1,000 feet deep, and it's the Gulf Stream, right? Crazy hurricane on the surface, Gulf Stream keeps marching on. All right, it's slower. It's based upon core things like population growth, period, consumer confidence, period, unemployment, period. But really, it's based upon, because that long-term chart I showed you where the 80s were terrible, but it only leveled off, that's because population didn't shrink in the early 80s. So even though we had crazy interest rates and not enough gasoline and a lousy economy back in that period of time, the housing market didn't really suffer. It just flattened out because the population still grew. People live indoors, et cetera, et cetera. Does that make sense? All right. All right, so what's next, Greg? This is an analysis that is the basis of so much of our conversation with our clients. There's a lot that goes into what feeds the local economy and what creates migration patterns, population trends, economic employment trends, et cetera. But this is the starting point. This is the 20-year chart for the county, all right? And so this is the country, blue chart. You saw this one a moment ago, right? This is the end of that chart, the last half of it. So housing boom, housing correction, housing recovery. Then you have a black line. This is Texas. No party, not much of a hangover, and a recovery anyway. So this was really interesting to a lot of people. This is one of the reasons why Wall Street piled in, because this showed that while everybody else was running amok, for whatever reason, Texas really wasn't. Now, there are real estate companies who will tell you, a CEO of a real estate company, a friend of mine will tell you, the housing market collapsed in this period of time. His company might have had a collapse, but the housing market didn't collapse. This is the data. It leveled off. So this is Bedrock. The green line is Houston, okay? So here is where they said oil prices are down, Houston's over. Here's where they said, all those idiotic headlines I showed you before, they happened along this chain right here, okay? Now, the only thing that I'd be thinking about, if I'm thinking about investing in Houston and I'm recommending Houston, is if this is the line, we're above it. Why are we above it? Is that artificial? Is that something we can't really count on continuing? And I think the answer is that little steep right here, not so steep. I think we're going to be in a not so steep period until we sort of do this for a while. This is the national average of home appreciation for the last 20 years, 3.44%. Texas is 4.1. Houston on this chart is 8. That's too much. It's only 8 because of what happened here. So it's awesome. It's the best in the country, actually. But this is not sustainable, so this is going to become this. All right? So me being honest about the fact that that shouldn't continue, you wouldn't want it to, because if that went up too much further, it would have to give some back. We don't want to give any back, right? It's like when you go to the casino. I don't mind not winning a lot, but I don't want to give any back if I can help it, right? Casino analogy, terrible idea. This is not a casino. Let me show you Atlanta, Georgia. Green line. Big party, brutal hangover, big recovery. People are saying that, see, the analysis is real simple. Start the line, split the peak and trough, carry it forward. Where are we, right? I think Atlanta just caught up after all these years. Atlanta got slaughtered because they built hundreds of thousands of houses in a 3-year period in Atlanta. So when the market turned, the market also turned with huge amounts of vacant, newly built houses. They had a very, very big oversupply problem that they had to work their way out of. But Atlanta is a beast. It's a population growth beast. It's just like all the big cities in Texas. New York can't get there fast enough. Here's another one, Tampa, Florida. Tampa, Florida, party hangover, recovery. All right, but again, people are saying, well, this is crazy. The prices are too high. It's 2008 all over again. Well, I could see why somebody would see this. They're not seeing this. We're the only company that produces this. People are seeing this and saying, this is crazy. It's just like this. Okay, fine, except that this is the trend line. It fought its way back. Guys, you're going to see market by market. If you start in the beginning, split the peak and trough of the green line and carry it forward, it's there. Here's Phoenix. Boom. It's right there. We have a fully recovered market right now that is not inflated, with exceptions maybe like Houston, where it needs to cool off a little bit. But the reason I share this with clients at every level is that I want you to realize that this is amazing. These are tens of thousands of buyers and sellers negotiating every year for a decade, 2 decades, producing a line here, one seller, one buyer, haggling it out 7 million times a year, and yet every market went back to where it was supposed to be in the first place. Are you seeing what I'm trying to show you here? Does it make sense? No matter where you go. All right, Kansas City, like the most boring chart in the world. Carry the line forward. I think we have upside there. All right, but I also see Bedrock here. I see a market that doesn't get spooked, doesn't get fooled, doesn't follow trends, just marches along, and I think is upside. Baltimore, Maryland. Everybody thinks Baltimore is a horrible place to invest, right? They picture police cars upside down on fire. That's what they picture when they hear Baltimore. Baltimore is in D.C., practically. It's in the D.C. metro area. So Baltimore did have that party, barely had a hangover. Like this is like, I would call this the fine tequila chart, because they had a big party, but it was good tequila, so it didn't hurt that much the next day. They hung on to their appreciation in Baltimore. This is a well-kept secret. We have clients who are buying there now. Detroit, ugly. Okay, should be here if all things are being equal. Auto industry left, auto industry is coming back. You getting the hang of this? Right? Jacksonville, you got the gist of that. Denver, Colorado. Denver, and then I'm out of time. Denver is a very interesting city because this was a total quality of life play. This was everybody who goes there doesn't want to leave. People go there on vacation, they wind up like quitting their jobs, they can't leave, okay? It's that good. But what happened in Denver, and some of you are thinking, who wants to say weed? Who wants to scream out weed right now? Somebody wants to say it. Usually somebody says weed. Thank you. They invited the cannabis business into their state, okay? And you don't have to love the politics of that to realize that that's going to be a monster industry. While every other state was either saying no or maybe, they said yes. And now the entire, like oil, set up shop, and natural gas set up shop in Houston. Cannabis is setting up shop in Colorado and Denver. And so as a result of that, I see a ski jump right here that I'm not afraid of. I think it'll level off again, but I think that that market has got such good fundamentals, and they're host to an entirely new industry now. And, all right, I'm going to bounce to the end here because I'm out of time. One of the things that I get asked all the time is, if Denver is so good but I missed it, where should I invest? Colorado Springs is the next thing. Okay, if Nashville is so good, where should I invest? Chattanooga. It's following suit. It's just 15 years behind. Well, I have Pittsburgh here because I think Pittsburgh is going to follow a similar track to, in some ways, Houston, because the energy industry struck natural gas there, and they're being very friendly to it. So this is a big buy for us. Dallas, big ski jump. Oklahoma City, people asked me 4 days ago, I want to put $100 million in. I don't want to go to Dallas. It's too crowded with too many investors. Where should I go? Answer, Oklahoma City. Same fundamentals, 15 years behind schedule. All right? And anybody have any questions? Anyone? Yes, sir. What's that? How do you get these charts? Go to renterswarehouse.com. Okay, right now you have to put a property in that you are looking at or own into a private account that only you can see, and you get all these charts and then some. In about 2 weeks, we're going to have something called the Research Center, where you can put a zip code or a town or a county, and up comes the charts. And it's not just that one. It's like 5 or 6 other market fundamentals. So thanks for asking that. Anybody else? Renterswarehouse.com in any browser. You'll find it there. It's free. Yep, free. Yes, sir. You can open a free account, put any address you want. A house you're thinking about buying, a house you already own, doesn't matter. Nobody else sees it but you. It's behind your password. But you're able to do all kinds of analysis, interactive calculators, maps, projections, photos of the property, and all these market fundamentals, all for free. Yes, sir. Yeah, the question is, can I talk about Wall Street's appetite for continued investment in single family? The answer is, it's the word insatiable comes to mind. Yep. Okay, the players that already came in paved the way. I want you to picture a dense forest, and the first major national players came through and hacked their way through. Now there's a highway going through. A lot of companies that have big capital in multifamily are moving over to single family. Okay, a lot of companies that are pension funds, insurance companies, university endowments, deep-pocketed companies are starting to realize that single family is a manageable asset tied to population growth, really solid, and they're looking to pile capital in. And what that means to small investors is that when you build a portfolio of 5, there's somebody who's got 25 trying to make their way to a 50 because they want to sell to somebody who's got 200 trying to make their way to 1,000 because they want to sell to one of those whales. So picture a food chain where there's guppy, small fish, medium-sized fish, big fish, whale. Now we've got whales on the end of our food chain. There's a current that you can swim in. where you didn't used to have any place to bring that. If you built a portfolio of 20 houses and you wanted to sell it, you sold and you got 50 houses, 49, 48, 47. Now you take the whole 50, serve it up, take your capital off the table, start again. We have a lot of clients that were in the business at an individual entrepreneurial level, got pretty good at it, are now flipping out of that portfolio intact, taking their capital, starting off someplace new. So ultimately, they compete with you for deals at times, but in the end, they're a buyer for what you build. Okay? Last question? Okay. Thank you very much. Appreciate it.
Thank you, sir. Thank you. Great job.